Good day, everyone. Our topic for discussion today is interbranch operations, and we'll be focusing on three major outlines, which are introduction to interbranch operations, accounts relating to interbranch operations, and the benefit of interbranch operations. Interbranch operations involve transactions that affect two or more branches of the same organization simultaneously. What interbranch operation makes possible is that, particularly within the financial sector, it is possible for the customer of a branch to transact in the branch of that same bank in another state. For example, I'm a First Bank customer. I open my account in Lagos. I should still be able to do deposit and withdrawal in Port Harcourt without any limitation. Time passed. This was a difficult thing to achieve. In the time past, a First Bank customer who opens his account in Lagos can't transact with that same account in Port Harcourt. Such person will actually have to open another account in Port Harcourt. But ever since the technology has improved, it has now become easy for branches to transact and service customers of other branches. The accounts relating to interbranch operations. We have four major types of accounts that makes interbranch operations possible. We have the interbranch cash payable account, the interbranch cash receivable account, the interbranch default settlement account, and the interbranch suspense account. All these four accounts makes it possible for banks to service other branches customers without difficulty. Picking them one by one, the interbranch cash payable account. The setup of this property makes it possible for a branch of the same institution to accept deposits on behalf of the customer domiciled branch. What we are trying to say here is that a branch A customer can decide to walk into branch B to make a cash deposit. This is possible because an account called cash payable account has been set up on the system. What happens is that once a branch A customer walks into branch B, the teller in branch B receives the cash from such customer, and the teller still in branch B is debited. An account called cash payable in branch B will also be credited. So what this means is that the branch B is supposed to remit that cash to branch A. So a payable account is a liability. So it means whatever cash a branch receives from another branch's customer is seen as a liability and is expected to be remitted to the original branch of the customer. So with a cash payable account setup, it's possible for other branches to service or to accept deposit from the customers of other branches of the same institution. another account called cash receivable account. The setup of this property makes it possible for a branch of the same institution to render cash withdrawal service to customers domiciled in other branches. What this does is that any institution that has this setup, it makes it possible for such branches to make withdrawals for customers of other branches. In time past, this was a difficult thing to achieve, but with the advent of sophisticated technology, it has become a very easy thing to achieve. With the setup of a cash receivable account, branches are able to perform withdrawals for customers of the same branch. What happens when a customer of other branch perform withdrawal in another branch is that the teller still in the branch doing the withdrawal is credited an account called cash receivable account is automatically debited, meaning the original branch of the customer has a remittance to do to the branch that performed the withdrawal. In other words, the amount, the word receivable means expecting. It means that the branch that is performing the withdrawal for such customer is expected to receive an equivalent settlement from the original branch of such customer. We also have another type of account called interbranch default settlement. The setup of this property makes it possible for the system to calculate the settlement amount required to balance up the trial balance of various branches affected by a branch transaction upload. A default settlement account is a setup that makes it possible for the branch's trial balance to still be balanced despite the interbranch transactions happening across those branches, where a customer of branch A walks into branch B to do deposit or withdrawal, and a branch B customer walks into branch A to do deposit or withdrawal. While all these transactions are happening, there is bound to be an imbalance in the branch's trial balance, but with a default settlement account set up on each branches, the system still maintains an equal trial balance at the end of the day. We have transactions that are uploaded via Excel, some of which are cash, some of which are non-cash. All these are settled automatically by an account called default settlement. Lastly, we have the interbranch suspense account. The setup of this property makes it possible for branches to carry out non-cash related transactions amongst one another. An example of a transaction that can be performed via this suspense account are movement of fixed asset from, let's say, head office to a branch. An head office may decide to procure, let's say, a printer, and decide to ship it to a branch. In doing that, the movement of the cost has to leave the head office books to the branch's books, so that further depreciation or further expenses that will be incurred in the use of that printer will be traced to the branch, not the head office. So after the physical printer is moved to the branch, the cost, the book value of that printer must also be moved from the head office books into the branch's book. So such movement can be passed via the interbranch suspense account. There are other things that can be passed via this suspense account as long as it is non-cash related. The interbranch suspense makes it possible for branches to do transactions with each other, and everything will still be fine. We have the benefit of interbranch operations. The first benefit is that it ensures local control of transactions. What we're trying to say here is that every branch can complete their own leg of a transaction. So for example, an head office is trying to move a printer from its books into a branch. Via the interbranch suspense, the head office will post its own leg of the transaction, which is crediting the printer account and debiting an interbranch suspense. That completes the head office leg. Then the branch that is receiving the printer will debit its own printer GL and credit the interbranch suspense. With this, it ensures local control of transaction. That is, the head office cannot perform a transaction that will directly affect the reports of the other branches. So there's a sort of autonomy. So it also provides transaction flow tracking. That is, for reconciliation purpose, if the head office is planning or is trying to move an asset from its books into the branch's books, the head office will perform its own posting. So if the branch fails to perform theirs, it will show up during reconciliation because the transaction flow will be shown as incomplete. The head office has completed its own, but the branch hasn't. It also helps to maintain branch trial balance reporting. A branch can perform a transaction on behalf of other branch. This is possible because the interbranch default settlement is in place, and it helps to automatically balance those transactions that happens across branches, where a customer of branch A walks into branch B to do deposit or withdrawal. Without an interbranch default settlement, there is bound to be an imbalance in the trial balance of the two branches. But with the default settlement in place, the system automatically posts the balancing figure for each of the branches into this GL, and at the end, the branches will still be able to maintain an equal trial balance. Thank you very much.